Welcome to the Cherry Beckert Tax Beat, a conversation about tax that matters.
Welcome to this edition of the Cherry Beckert Tax Beat podcast. 2024 has been filled with natural disasters, fires, hurricanes, tornadoes, floods. The IRS offers taxpayer return filing and payment relief in many counties across the U.S. in conjunction with these disasters. At this point, more than 60 disaster relief notices have been issued so far this year. That's one form of relief, and we'll briefly touch on that during this podcast. The other part of relief is that the code and regulations offer some advantages to taxpayers whose property has been damaged by a federally declared disaster, and that's going to be the primary focus of this podcast. Joining in today's conversation is Mark Gianardo, partner and tax technical director for the firm. Mark practices in our South Florida offices and has recent experience, probably more than he cares to recall, working with clients impacted by hurricanes. So, hello, Mark. How are you doing today?
Well, Brooks, thank you for having me today. It's a pleasure for me to be here.
And just for comparison, how is the weather in sunny Florida today?
It's actually very nice, high 80s and sunny. And we expect afternoon showers like we do every day this time of year. So it's all good. It's all good.
But no hurricanes, tropical storms, or tsunamis on the horizon for the week.
Not that we're aware of, no.
All right.
No.
Yeah, but you are in Florida, and that can change at any time, I guess.
Yes,
all right.
It can.
All right. So let's just do a little background. The first I'm going to touch on is the relief for filing and, in some cases, payment of tax returns, tax payments that the IRS offers for federal relief. These tend to be very state and county specific. We'll go in just a little bit more in detail on that at the end. But again, the main focus is looking at casualty losses and deferrals of casualty gains. All right, so when these disasters occur, obviously the first and foremost important goal, safety, health, and well-being for families and communities. As recoveries begin, taxpayers start dealing with insurance claims, loss deductions, all sorts of economic issues that quickly lead to tax issues. In the wake of many of these disasters that occurred in 2024, we want to take a moment to discuss losses for damages to business property and personal property from a federally declared disaster. The TCJA, or the Tax Cut and Jobs Act, provisions may impact both businesses and individuals, taxpayers claiming losses. We'll touch on that. And finally, we'll touch on the tax rule that is beneficial to those who may experience a casualty gain, which is not as uncommon as one may think when you look into the rules exactly how a casualty gain. And I think I'll just preface that by saying there's a big difference between an economic gain, which is very rare in these situations, versus a tax gain, which is not so rare. All right, so you're up, Mark. First step is to understand how TCJA impacts casualty loss deductions.
Thank you, Brooks. Well, first of all, a casualty is the complete or partial destruction of property that results from an identifiable event of a sudden, unexpected, or unusual nature, such as a fire, storm, shipwreck, car crash, or similar event. Progressive deterioration from a steadily operating cause is not a casualty. The property must suffer physical damage and not just a decline in value, even if that decline resulted from being in or near an area where casualties have occurred and might occur again. For 2018 through 2025, personal casualty and theft losses of an individual are deductible only to the extent that they're attributable to a federally declared disaster, and to the extent the $100 per casualty or 10% of AGI limits are met.
So let's come back to those limits in a minute, but how is the amount of a loss determined?
Well, for property held for personal use, the amount of the casualty loss is the lesser of, 1, the property's adjusted basis, or 2, its decline in value. Decline in value is simply the fair market value immediately before the casualty minus the fair market value immediately after the casualty. For property used in a business or held for the production of income, the amount of the casualty loss is determined under the same rules as for personal use property, except that if the property is totally destroyed, the amount of the loss is the property's adjusted basis in all cases.
So really, you're limited to your basis, but that decline in value might be less than the basis in the property if it's not totally destroyed. But that, determining fair market value before and after seems like a difficult task. How can a taxpayer determine that decline in value?
Well, the decline in a property's value should really be ascertained by competent appraisal where possible. However, the cost of making repairs, replacing or cleaning up property after a casualty can be used to measure the amount of the loss or the decline in value. If the repair, etc., is necessary to restore the property to its pre-casualty condition, and so long as the amount spent is not excessive. The repairs do no more than take care of the damage suffered, and the post-repair value is no greater than the pre-casualty value. So basically, what you spend is a good indication of the decline in value, and that's often how we actually document the decline, is looking at how much is actually spent to bring the property back to pre-casualty conditions.
Right. So how does an insurance payment or maybe FEMA funding or all these other sources of funding that are coming in from donations affect that loss that a taxpayer may be trying to claim?
Well, it's important to realize that a casualty loss deduction is not allowed to the extent that the loss is compensated by insurance or otherwise. So that would include, insurance payments or FEMA payments or any other type of payment that you might receive.
All right. So let's go back to what we were mentioning earlier, these nasty limits. Yes. The TCJA limits that apply to individuals or potentially apply to individuals. So can we go into those a little more in depth?
Sure. An individual can deduct a casualty loss on personal use property to the extent that the casualty loss exceeds $100 and all of the individual's casualty losses for the tax year exceed 10% of adjusted gross income for the year.
That's pretty daunting for taxpayers to get over, but I would guess 10% of adjusted gross income, depending upon what the property was that was damaged and how high their adjusted gross income is. But those limits don't apply to business losses.
Correct. Those limits only apply to individuals claiming losses on Schedule A, itemized deductions for damages incurred in a federally declared disaster area. Businesses are not subject to these limitations. In prior years, Congress has enacted legislation to waive these limits.
So we'll have to wait and see if that happens for all of the hurricane damages that happened this year.
Yes.
All right. So as kind of a corollary to the business losses on an individual return, having more lenient losses, what about true business entities? How do these limitations apply to business returns?
Right. Well, if the loss is large enough to cause the company to actually have a net operating loss carry forward, that NOL is limited in future years and can only offset up to 80% of the taxable income in that future year. So,
and in my mind, I guess we need to get to clarity. That makes really obvious sense on a C corporation. What about in a entity, kind of a pass-through entity context? Do individuals with pass-through entities get any benefit from that same provision?
Well, they do, but the limitations on individuals would kick in and apply once that loss flows up to the individual level.
All right. Okay. All right. So there's also some timing rules, that when we're looking at when do you get to claim the loss, how does that work, Mark?
Well, the casualty loss is considered sustained only during the tax year that the loss occurs, as fixed by identifiable events occurring in that year. A loss may be sustained in the tax year, even though repairs or replacements aren't made until a later year. Taxpayers generally can claim the loss in the year that it occurred or elect to claim the loss on the prior year tax return.
Which could be helpful if a taxpayer owed a lot of money on their 23 return rather than taking the loss on their 24 return. They could go back and take it on the 23 return, either by filing an amended return, or if they haven't filed yet, they could still take it on their 23 return instead of claiming it as a 24 event.
That's correct.
And there can also be a play looking at AGI limits. You know, if you happen to have a large capital gain in this year, but not in one year, the timing can be very important if you're looking at the 10% AGI limit on the personal casualty loss. So
absolutely right. Absolutely right.
So we talked about deducting losses where there's a casualty, but sometimes there's a casualty gain. That is, a taxpayer is going to receive more in insurance payments and proceeds than the basis or of the property that was destroyed, or even the damages to that property. So if you're getting insurable value at fair market value, but your basis is pretty low in that property, then when your insurance proceeds come in, they can be pretty high if you don't reinvest all those proceeds. Talk a little bit about recognizing that gain and what can be done.
Sure. Well, a casualty gain must be reported for tax purposes, but there is Code Section 1033, which allows the deferral when you have gain from what's called an involuntary conversion of property. If a taxpayer uses all of the insurance proceeds received from a casualty to purchase replacement property within a required period, the casualty gain will not be taxed. However, the basis of the replacement property is reduced by any untaxed gain. Thus, the gain is deferred but not avoided. It's built into the replacement property. So gain will be recognized to the extent the cost of the replacement property is less than the amount of insurance proceeds. Deferral period can be 2 years to 4 years, depending on the property and depending on the disaster.
And I would just say, an overarching policy point here is that Congress doesn't really want people to have to pay tax on getting insurance from disaster coverage. And so hopefully with proper planning and consultation with your CPA, you will avoid reporting that gain. But as I said earlier, having an actual tax gain is not uncommon in these situations. Having an economic gain is uncommon.
Yeah.
There's a distinction there.
Right. And if it's a personal residence, there is still the gain exclusion of $250,000 or $500,000 that can be used if some of these insurance proceed gains are going to be recognized. So there's still that opportunity to consider as well.
Okay, so Sarah, let's just flip back to that our related issue of deadline, I'll just call it deadline relief in conjunction with federal disasters. So there are some nuances here, but can you explain the general feel of this program? Obviously, we can't go into the details of whatever 60 or whatever there have been this year, but in the big picture, how does this work?
Right. So using Hurricane Helene as an example, then and South Carolina, where I am, that the relief offered by the IRS is driven by, first, FEMA has to do their work and survey the area to get the federal designation as a federally declared disaster. Then the IRS can act to provide relief. So there's usually some bit of lag and timing in there. And so what the IRS did is push off the filing due date and payment due date for all tax returns that are initially due or extended returns that are due in the period from the date they determine is the start of the disaster in that area all the way out until some period of time. In the case of Helene, it's till May 1. that tax returns and payments that are due between September 25, I believe it is, until that date can be filed. So that means fourth quarter estimated tax payments, first and second quarter estimated tax payments, extension payments, 2024 tax returns, any 23 extended tax returns that haven't been filed can all be filed in that later date. That is not a new extension date. It is a postponement of the filing date, which is very important when considering the statute of limitations. Unless the IRS extends the statute of limitations to incorporate these extended periods, that's very important to consider. Not necessarily today, but if you wanted to file a refund claim down the road, you're going to have to pay attention to that if you're coming up on the end of the statute of limitations period. I think the other thing to note is if you are not in one of these official disaster areas, say you don't live in South Carolina, but you get a K-1 from a partnership that is in South Carolina, and so therefore your return is also eligible for the filing relief. Your other tax payments are not subject to relief, other tax filings, but your individual tax return or the return where you're waiting for a K-1 from a partnership that is in a disaster area that's delaying its filing, you too are benefited from that and will not be considered as filing your return late at that point. So does that sort of address kind of the ideas you were thinking about?
Yeah, and I'll just add two more little comments to that. One is if your CPA preparer is in a disaster zone and you're not, then you also can get the benefit of some of this filing postponement relief. And I think a key nuance in all this that, there are all sorts of different disaster reliefs offered, but you really have to pay attention to the difference between payment postponement and filing postponement. And in many of these cases, if the disaster happened after April 15th, for example, in many cases, the IRS is going to say you should have had your taxes paid in by April 15th. Therefore, even though we're giving you an extension or postponement deadline on filing, we're not giving you an extension on what should have been paid in by April 15th. We're giving you an extension on what has to be paid afterwards. And that can, anyway, all these are very factual and disaster specific. They're looking at that interaction between payment and filing relief and which specific taxes are subject to what. So hopefully that made sense.
Yeah.
Okay. All right. So let's move on to final comments. Mark, do you have any concluding words of wisdom you would like to share?
Well, I think it's, as you mentioned, Brooks, everything is very factual specific. So depending on your situation, it's important that you reach out to us or to your tax preparer to determine, what opportunities are there for you in this situation. But Brooks, I appreciate being here today. Thank you for having me.
Awesome. All right. Ms. McGregor?
Yeah, I would say record keeping, even though it's difficult following a disaster, keeping good records of all the expenditures made to recover the property, prepare the property, and use that, if you're going to use that as the basis for claiming your losses. Really important to keep good documentation about that you didn't over restore your property. You put it back to where it was before, and this is the cost and the effort that it took.
Okay, and for my part, I'll echo what Mark said. There's a lot of complexity in this area. I sometimes can be hard on our IRS and some of the bureaucracy and its communication, but I think I do think they do a particularly nice job on disaster relief pronouncements and keeping track of them on the website. So we'll put a link in with all this stuff. And you can go out there by state and look at exactly what relief is available by state and by county fairly easily. It is one of the better, I really do think it's one of the better things that the IRS does do. Okay, I think that's a wrap on today's discussion on disaster relief provisions. Thank you for listening in. A quick disclaimer that we are not providing tax advice on this podcast. Please consult with your tax advisor, hopefully at Cherry Beckert, with your specific tax issues or to discuss information from today's podcast. Check out the firm's website at cbh.com for the latest guidance and materials on this and other tax and business topics. This concludes today's podcast. Please like, share, and subscribe. Thank you, Mark. Thank you, Sarah. Thank you, our listeners, for spending your time with us. We truly appreciate it. Let's call it a day and go forth in peace.